Question 1. The part of an insurance policy that contains the insurer's promise to pay for a covered loss is known as the A. Declarations, B. Conditions, C. Insuring agreement, D. Exclusions. Answer: C. Insuring agreement. The insuring agreement is the core of the insurance contract, as it outlines the specific promises the insurance company makes to the insured. This section describes the covered perils, or causes of loss, and forms the basis for the policy's protection, directly stating what the insurer agrees to do in exchange for the premium. For example, in a property policy, it would state that the insurer will pay for direct physical loss to the covered property caused by a covered peril. Think of the insuring agreement as the insurer's main promise in the policy. Question 2. An insured owns a building valued at $500,000. They purchase a property insurance policy with a $400,000 limit and an 80% coinsurance clause. If a fire causes $100,000 in damages, how much will the policy pay, ignoring any deductible? A. $80,000. B. $100,000. C. $40,000. D. $50,000. Answer: B. $100,000. The policy will pay the full loss amount because the insured met the coinsurance requirement. The coinsurance clause requires the insured to carry an amount of insurance equal to a specified percentage, here, 80%, of the property's value at the time of loss to receive full payment for partial losses. In this case, the property's value is $500,000, so the required insurance is $400,000. 400,000. 500,000 x 0.80, which is exactly the amount of insurance the insured purchased. Since the requirement was met, the insurer pays the full amount of the partial loss, which is $100,000. Question 3. All of the following are essential elements of a legally binding contract except A. Agreement, offer and acceptance. B. Competent parties. C. Legal purpose. D. Written evidence. Answer: D. Written evidence. A legally binding contract requires 4 key elements: agreement, consideration, competent parties, and legal purpose. While it is always a best practice to have a contract in writing, a written document is not universally required for a contract to be legally enforceable. Oral contracts can also be valid. For example, a person can verbally agree to purchase a service, and if the other elements are present, a valid contract is formed. Remember this tip: an insurance policy is a formal contract, but the underlying legal principle doesn't always mandate that every contract must be in writing to be valid. Question 4. In a property insurance policy, what is the term for a cause of loss, such as fire, lightning, or theft? A. Hazard. B. Risk. C. Peril. D. Exposure. Answer: C. Peril. A peril is the direct cause of a loss, which is the specific event that insurance protects against. Common examples in a property policy include fire, windstorm, hail, and vandalism. The policy's insuring agreement lists the perils that are covered. A simple way to distinguish this is to remember that a peril is what happens, like a fire, while a hazard is a condition that increases the chance of it happening, like faulty wiring. Question 5. Which part of the personal auto policy, PAP, covers medical expenses for the insured and their passengers, regardless of who is at fault in an accident? A. Part A, liability coverage. B. Part B, medical payments coverage. C. Part C, uninsured motorists coverage. D. Part D, coverage for damage to your auto. Answer: B. Part B, medical payments coverage. Part B, medical payments coverage is designed to pay for reasonable medical and funeral expenses incurred by the insured, their family members, and passengers in their vehicle due to an auto accident. The key feature of this coverage is that it pays regardless of who was at fault, making it a form of no-fault coverage. For example, if the insured is injured in their own vehicle, medical payments can cover their hospital bills up to the policy limit, even if the insured caused the accident. This coverage is meant to provide prompt payment for medical needs without waiting for a fault determination. Question 6. The legal doctrine that prevents a party from reasserting a right they have previously waived is known as A. Adhesion, B. Subrogation, C. Indemnity, D. Estoppel. Answer: D. Estoppel. Estoppel is a legal principle that prevents someone from arguing something or asserting a right that contradicts what they previously said or did. It often works in conjunction with waiver, which is the voluntary relinquishment of a known legal right. For instance, if an insurer consistently accepts late premium payments without penalty, a waiver, they may be estopped from later canceling the policy for a single late payment because their past actions led the insured to believe it was acceptable. This protects the insured from being misled by the insurer's actions. Question 7. Which of the following is an example of a moral hazard? A. A driver who is texting while operating a vehicle. B. Leaving oily rags in a pile in the garage. C. An individual who intentionally damages their own property to collect an insurance claim. D. Living in an area prone to earthquakes. Answer: C. An individual who intentionally damages their own property to collect an insurance claim. A moral hazard arises from a person's character or dishonest tendencies, where they might intentionally cause or exaggerate a loss to profit from insurance. Intentionally damaging one's own property is a classic example of this because it involves a deliberate, fraudulent act driven by a flawed moral compass. This is different from a moral hazard, which is carelessness, like texting and driving, or a physical hazard, which is a tangible condition, like oily rags. Think of moral as relating to morals and ethics. A moral hazard involves an intent to deceive. Question 8. The tendency for individuals with a higher than average chance of loss to seek insurance more aggressively is known as A. Risk avoidance, B. Adverse selection, C. The law of large numbers, D. Risk retention. Answer: B. Adverse selection. Adverse selection is the term for the insurance company's challenge of attracting a balanced group of risks when people who are most likely to file a claim are the ones most eager to buy insurance. For instance, a person who knows their factory has a faulty roof is more likely to seek hail damage insurance than someone with a brand new roof. Insurers combat adverse selection through the underwriting process, where they evaluate risks and charge appropriate premiums to ensure the risk pool remains stable and profitable. A good way to remember this is that the insurer is trying to avoid an adverse or unfavorable selection of clients. Question 9. Under a standard homeowner's policy, which of the following would be covered under coverage C, personal property? A. The insured's car parked in the attached garage. B. A tenant's laptop located in the rented room. C. The insured's furniture in a storage unit. D. The family dog. Answer: C. The insured's furniture in a storage unit. Coverage C. Personal property typically provides coverage for the insured's belongings anywhere in the world, though it often limits the amount of coverage for property kept off the insured premises. Furniture in a storage unit is considered the insured's personal property and would be covered, usually up to 10% of the coverage C limit or $1,000, whichever is greater. Motor vehicles, property of tenants, and animals are specifically excluded under standard personal property coverage. This extension of coverage ensures that your belongings are protected even when they are not physically inside your home. Question 10. When an insurer pays a claim, it gains the right to pursue recovery from any third party who was responsible for the loss. This principle is known as A. Contribution, B. Arbitration, C. Indemnity, D. Subrogation. Answer, D. Subrogation. Subrogation allows an insurer to step into the shoes of the insured and sue the at-fault party to recover the amount it paid on a claim. This prevents the insured from collecting from both their insurer and the responsible party for the same loss, thereby reinforcing the principle of indemnity. For example, if another driver runs a red light and hits your car, your insurer might pay for your repairs and then subrogate against, meaning, seek repayment from, the at-fault driver or their insurance company. A good way to remember this is that subrogation sounds like substitute, as the insurer substitutes itself for the insured in the legal action. Question 11. Which part of an insurance policy personalizes the contract by stating who is insured, what property is covered, the policy limits, and the policy period? A. Insuring agreement. B. Declarations. C. Conditions. D. Endorsements. Answer, B. Declarations. The declarations page, often called the deck page, is the section that contains the unique information specific to that policyholder. It answers the fundamental questions of who, what, where, when, and how much, including the named insured's address, the property description, coverage amounts, premium, and the effective dates of the policy. Think of the declarations as the cover page of your policy that customizes the standard contract to your specific situation. This is always the first place to look to find the basic details of your coverage. Question 12. In property insurance, the policyholder is required to have an insurable interest in the property. A. Only at the time the policy is purchased. B. Continuously throughout the policy period. C. Only at the time of loss. D. Both at the time of purchase and at the time of loss. Answer, C. Only at the time of loss. For a property insurance contract to be valid, insurable interest, a financial stake in the property, must exist at the moment the loss occurs. This principle ensures that the insured would suffer a genuine financial loss if the property were damaged or destroyed, which prevents insurance from becoming a form of gambling. For example, if you sell your house, you no longer have an insurable interest in it, so you cannot collect on an insurance claim if it burns down a week later, even if your old policy is technically still active. The key takeaway is that for property, the financial connection must be present when the damage actually happens. Question 13. Which of the following dwelling policy forms provides coverage on an open perils basis for the dwelling and other structures? A. DP1, basic form. B. DP2, broad form. C. DP3, special form. D. All dwelling policy forms. Answer, C. DP3, special form. The DP3, special form, provides the highest level of property protection among the standard dwelling policies, offering open perils coverage on the dwelling, coverage A, and other structures, coverage B. Open perils means that a loss is covered unless it is caused by a peril specifically listed in the exclusions section. In contrast, the DP1 and DP2 forms use a named perils approach, which only covers losses caused by the specific perils listed in the policy. Think of the DP3 as special because it offers this more comprehensive, all-risk type of coverage for the building itself. Question 14. An insurance contract is prepared by the insurer and offered to the insured on a take-it-or-leave-it basis. This makes it A. Unilateral contract. B. Aleatory contract. C. Contract of adhesion. D. Personal contract. Answer, C. Contract of adhesion. An insurance policy is a contract of adhesion because one party, the insurer, writes the contract's terms, and the other party, the insured, must accept them as written without negotiation. Because of this imbalance in drafting power, any ambiguity or unclear language in the contract is typically interpreted by the courts in favor of the insured. The term adhesion refers to the fact that the insured must adhere to the terms presented. So, if a policy wording is vague, the benefit of the doubt goes to the policyholder. Question 15. The valuation method that pays for the cost to repair or replace damaged property without a deduction for depreciation is known as A. Actual cash value. B. Stated value. C. Replacement cost. D. Market value. Answer: C. Replacement cost. Replacement cost valuation is designed to restore the insured to their pre-loss condition by paying the full cost of replacing the damaged property with new property of like kind and quality, up to the policy limit. Unlike actual cash value, ACV, it does not subtract for depreciation, which is the loss in value due to age, wear, and tear. For example, if a 10-year-old roof is destroyed, a replacement cost policy would pay for a brand new roof, not the depreciated value of the old one. This type of coverage is more expensive but provides a more complete financial recovery. Question 16. A business that is eligible for a business owner's policy, BOP, would typically be A. A large manufacturing corporation with high-risk operations. B. A small, low-risk retail store or office. C. An international shipping company. D. A municipal government entity. Answer: B. A small, low-risk retail store or office. A business owner's policy, BOP, is a package policy specifically designed to meet the property and liability needs of small to medium-sized, low-risk businesses. Insurers have very specific eligibility criteria, often based on square footage, annual revenue, and type of operation, favoring businesses like retail stores, professional offices, and small apartment buildings. The BOP bundles common coverages together at a premium that is typically lower than if each coverage were purchased separately. Think of a BOP as a homeowner's policy for small businesses due to its convenient, pre-packaged nature. Question 17. All of the following are primary elements required to establish negligence in a liability claim except A. Legal duty owed. B. Breach of legal duty. C. Malicious intent. D. Proximate cause and damages. Answer: C. Malicious intent. Negligence is based on carelessness or a failure to act with reasonable prudence, not on a person's intent to cause harm. The four required elements to prove negligence are a legal duty owed to others, a breach of that duty, proximate cause linking the breach to an injury, and actual damages or injury. Malicious intent would elevate the act from simple negligence to an intentional tort, which is a different legal concept and often excluded from liability policies. Remember, negligence is about being careless, not being criminal. Question 18. A statement made by an applicant on an insurance application that is believed to be true to the best of their knowledge is called A. Warranty. B. Representation. C. Concealment. D. Waiver. Answer: B. Representation. A representation is a statement made by the applicant that they believe to be true when applying for insurance. The insurer uses these statements to underwrite and rate the policy, but they are not guaranteed to be absolutely true. This is different from a warranty, which is a statement guaranteed to be true and can void the policy if found to be false. If a representation is later found to be false and is material to the risk, the insurer may have grounds to rescind the policy, but an innocent mistake in a representation is not as severe as a breach of warranty. Question 19. A policy that protects against catastrophic liability losses and sits on top of primary liability policies like homeowners and auto is called A. Inland marine policy. B. Business owner's policy. C. Umbrella policy. D. Difference in conditions policy. Answer: C. Umbrella policy. A personal umbrella policy provides an extra layer of liability protection above and beyond the limits of an insured's underlying policies, such as their auto or homeowner's insurance. It is designed to cover very large liability claims that would exhaust the limits of the primary policies, protecting the insured's assets from being seized to pay a judgment. For example, if an insured's auto liability limit is $300,000 and they are sued for $1 million, the umbrella policy would cover the remaining $700,000. It's called an umbrella because it provides broad coverage over everything underneath it. Question 20. A fire that starts in the kitchen and spreads to the rest of the house, with smoke and water damage also occurring as a result of the firefighting efforts, is an example of a loss caused by A. Direct cause. B. Indirect cause. C. Proximate cause. D. Concurrent cause. Answer: C. Proximate cause. Proximate cause is the legal principle that holds that an unbroken chain of events resulting from a covered peril is considered part of the same single loss. In this scenario, the fire is the proximate cause, and the resulting smoke and water damage are considered direct consequences of that initial event, making them covered as well. Even though water, not fire, damaged some items, the fire was the initiating peril that set the whole sequence in motion. Remember that proximate cause connects all the related damages back to the original covered event. Question 21. Which type of insurance provides coverage for an employer's liability for employees' work-related injuries or occupational diseases? A. General liability insurance. B. Professional liability insurance. C. Workers' compensation insurance. D. Disability insurance. Answer: C. Workers' compensation insurance. Workers' compensation insurance is a mandatory type of insurance in most states that provides coverage for employees who get injured or sick as a direct result of their job. It covers medical expenses, lost wages, and rehabilitation costs, and in exchange, the employee generally gives up the right to sue the employer for negligence. This system, known as the exclusive remedy, ensures that injured workers receive care without having to go through a lengthy lawsuit. It is a fundamental coverage for any business with employees. Question 22. If an insured wants to add or modify coverage on an existing property or casualty policy, the change is made through A. Binder. B. Endorsement. C. Application. D. Renewal certificate. Answer: B. Endorsement. An endorsement, sometimes called a rider, is a written amendment added to an insurance policy to change its original terms, such as adding, removing, or modifying coverage. For example, an insured might add a scheduled personal property endorsement to their homeowner's policy to provide specific, higher limit coverage for valuable jewelry. An endorsement becomes a legal part of the policy and is used to customize the standard contract to fit the specific needs of the policyholder. Think of an endorsement as an official edit to the policy document. Question 23. The standard homeowner's form designed to provide coverage for the contents and personal liability of a renter living in an apartment is the A. HO3 Special Form. B. HO6 Unit Owner's Form. C. HO5 Comprehensive Form. D. HO4 Contents Broad Form. Answer: D. HO4 Contents Broad Form. The HO4 policy, commonly known as renter's insurance, is specifically designed for tenants who do not own the building they live in. It provides named perils coverage for the insured's personal property, coverage C, and includes personal liability coverage, coverage E, and medical payments to others, coverage F. Since the renter doesn't own the structure, the HO4 does not include coverage for the dwelling itself. A good way to remember this is, HO4 is for the tenant on the floor. Question 24. A provision in a property policy that requires the insured to pay for a portion of the loss before the insurer will pay anything is the A. Coinsurance clause. B. Deductible. C. Other insurance clause. D. Premium. Answer, B. Deductible. A deductible is a form of risk sharing where the insured agrees to absorb the initial part of any loss. The insurer is only responsible for paying for losses that exceed the deductible amount, which helps to eliminate small claims and keep premiums affordable. For instance, if you have a $1,000 deductible on your auto policy and suffer a $5,000 covered loss, you would pay the first $1,000, and the insurer would pay the remaining $4,000. The deductible is one of the most fundamental concepts in property and casualty insurance. Question 25. The authority that is not explicitly written in an agent's contract but is necessary to carry out their authorized duties is known as A. Express authority. B. Apparent authority. C. Implied authority. D. Fiduciary authority. Answer, C. Implied authority. Implied authority is not written down but is reasonably assumed in order for an agent to perform their duties under their express authority. For example, an agent's contract may expressly grant them the authority to solicit applications for insurance, which implies they also have the authority to print business cards and set up appointments. This is different from express authority, which is written in the contract, and apparent authority, which is based on what the public reasonably believes the agent can do. Implied authority is about the necessary, unstated actions needed to get the job done.